Welcome to Looking at the Markets with David Modell. Today I've got a real chartist who's going to show us some charts and some other cool stuff. His name is Mr. J.C. Parets. He's the founder of Eagle Bay Capital as well as AllStarCharts.com. You're going to want to check that link in the description. He started trading at age 21, earned a degree in finance from Fairfield University, and started working as an intern for Merrill Lynch back in 2003. Since then, he's been featured on ABC, CNBC, CNN, Bloomberg, The Wall Street Journal, and Yahoo Finance, among others. Mr. Parets is known worldwide as a premier chartist and market expert, and now I'm fortunate enough to have him on Looking at the Markets. Thank you, Mr. Parets, for joining me today, sir.
No, thank you for having me. And enough with that Mr. Perret stuff. That's my dad.
Gotcha. It's a habit. I just can't get out of it. So
No
yeah, I
question.
see a chart right now, and I see, is that a moving average and a 14-period RSI? And I think it's the spiders, or at least the S&P 500. So how do you use these indicators to improve your probabilities when it comes to trading?
Sure. This has been a process that's been, refined over a lot of years, and it's a lot of mistakes made, a lot of books read. In some cases, these are things that I've learned from other people. In some cases, you just got to get beat over the head enough times where you just figure it out on your own. And what you see, in my work is really a combination of a lot of these things. But I would argue, I'm lucky that the majority of the things I learned I was able to learn from others rather than the hard way. But it's a healthy combination of both, to say the least. So you mentioned the 200-day moving average. That's what I use. I use a 200-day simple moving average. I'm not trying to get fancy or get cute or build any ridiculous moving average crossover trading algorithms. Like, that's not what I'm trying to do. What I use a moving average for is to help identify the direction of the primary trend, and that's why we use technical analysis. That is step one: is identify the direction of the trend. Is it going up or is it going down? And as simple as that sounds, and I tell people that, and they're like, "Really? That's what you do? You just look at the chart and is it going up or going down?" That's where it begins. That's the first thing that you want to recognize. Listen, if you want to buy something, do other people agree with you? Like, is it already going higher, or are you trying to be that one savior that is, you're the one freaking genius that's going to decide that this is the bottom for the stock? Come on, So markets trend, and that's why technical analysis works. That's why we implement it, because we are looking for these trends. And you can go back, there are zillions of charts going back 100 years, and you could just pick them out. Well, during this period it was going up, during this period it was going down. I mean, you can give it to an 8-year-old and he'll give you the same answer. So it's very simple. I mean, you can't argue that. Markets trend, right? So if they do that, we want to find them and we want to participate in them. And that's why technical analysis works, because we are using the behavior of price to identify those trends. The moving average is a smoothing mechanism that, in the case of a simple moving average, or others like exponential and geometric and all sorts of fancy stuff. But I'll keep it simple, stupid kind of guy. The SMA, the simple moving average, I use a 200 period, mostly because that's my time horizon, right? A 50-day moving average is too short term for me. It's too noisy. It whips around way too much. I'm not trying to add noise. I'm trying to eliminate noise, and the 50-day I eliminated that out of my arsenal a long time ago. So a 200-day is good if prices are above, and the reason for that, again, getting back to time horizon, is because I don't care necessarily what happened today, and I really don't care what's going to happen next year. I'm curious as to what's going to happen over the next several weeks and several months, right? That's my sweet spot. We want to make money this quarter. Like, that's kind of where I'm looking at. And the 200-day is essentially the average price over the last 10 months or so. Just do the math. But
Sure.
If prices are making higher lows and higher highs above an upward sloping 200-day moving average, it is not a downtrend, right? And I think something that gets lost in the shuffle is identifying what it isn't, right? What it's not. If we're at a zoo, we could be like, well, that's a giraffe, or we could say, well, we don't know whether it's a giraffe or a horse, but we know it's not a monkey. You know what I mean? Like, or we know it's not a fish. We know it's not a shark. We can already start eliminating all of these options to narrow it down to, hey, it's probably one of these couple animals, an elk or a deer or a stag or whatever, you know what I mean?
Right.
And kind of narrow it down. So it's the same thing with markets. We know it's not a downtrend, so that means it's either an uptrend or a sideways trend. So we want to be investing in that direction with that thesis. So So that's really all a moving average does for me. And then you asked me about the 14 period RSI.
Yep.
Yep, that's exactly what I use. Some defaults in charting softwares use a 10 period. Some use 14. I'm a 14 guy. That's how I learned it. That's how I use it. That's how I mean, I've been following this damn indicator for so many years. Like, I trust me, I know what this thing, how this thing behaves.
Yeah.
So, I use it in two very simple ways. I first, in the same way that we identify the direction of the primary trend, we actually have the technology. So here's allstarcharts.com. If you go to education, really all this is a collection of posts that I've put together over the years. In this case, we're talking about momentum, so I can just show you. We can go to the momentum, and this is all free. Anybody can go there. You can go to the momentum, and you can see what we're looking for. David, you have a good view of this, don't you? You can see this well?
Clearly.
Okay, great. I can actually click on this,
Yep.
and you can see here that just like we identify the direction of the primary trend with price in a very simple, it takes you literally 3 seconds to come to that conclusion. Is it up, down, or sideways, right? There's only three options, so it's not, rocket science. We do the same thing with momentum. So here we want to identify if momentum's in a bullish range or if momentum is in a bearish range. And all a 14 period RSI is, it's a momentum indicator. That's it. So, with that being said, it's a supplement to price. So when people ask me, hey, JC, what's your favorite technical analysis indicator? It's price, right? Everything else is a far second to that. So one of my favorite secondary indicators is momentum. So here you're looking at a bullish range, and here you're looking at a bearish range. So the RSI is a oscillator. So what that means is that it goes from 0 to 100. So traditionally 70 would be overbought, 30 would be oversold.
Right.
If prices are in uptrends, making higher lows, higher highs, everything's hunky-dory, when nothing goes straight up, right? Price is correct. It's higher lows and higher highs. So when you have a correction within an uptrend, what's going to happen oftentimes is that momentum's not going to get oversold. It's going to stay above oversold levels, right? It's not going to drop below 30. And then when prices make new highs, you're going to get overbought. You're consistently going to get over 70, but you're never going to get into 30. So if you think that the stock's in an uptrend and all of a sudden you see momentum break 30, you probably want to reevaluate that thesis. Same thing to the downside, right? If you see momentum in a bearish range, if prices are making lower lows, lower highs, look at financials in 2008, classic example.
Yeah.
When you got those counter trend rallies, right, because nothing goes straight down, momentum will stay below 70. In fact, the worst bear markets, it'll stay below 50, right? The strongest bull markets, momentum will stay above 50, like Tesla, like in 2013, 2014. So, when you get those counter trend rallies, like financials had vicious rallies in 2008, right? Counter trend, none of them got over 70, never of them got overbought, right? They always got oversold when they sold. So a very simple way that easy to incorporate, right?
Sure. What's interesting is that some people might see the RSI go below 30 and think, oh boy, it's a bargain. But you're also looking at the overall trend with the 200-day SMA, and you're saying, no, not a bargain. This is a falling knife. Get out of the way. That's the impression I'm getting.
Either a falling knife or a lack of trend, and it's just going to be dead money. Either way, you don't want to be buying it, right?
Yeah.
So it's not necessarily that it's a short. It's just further evidence that it's not a buy.
Sure.
And then when you're looking for that turn, one of the things that I like to look at is look for divergences.
Yeah.
And really, these are the only two ways I use momentum, by looking to see what kind of range it's in and looking for divergences. So if you're in a downtrend and prices are making lower lows, lower highs, and you put in lower lows in price and momentum puts in a higher low, that's a bullish divergence. That's an indicator that momentum, something's changing, right? Not necessarily reversing, but certainly changing. And then in this example, you saw how then momentum got overbought. So now you have a bullish divergence and overbought conditions well before you got a rally. By the way, this is a real chart. This is actually silver in the summer of 2012. So you had plenty of opportunity to cover your shorts or get long with confirmation that you're now in a new bullish range before any sort of breakout and monster rip into the end of the year. And then it works both ways on the way down, right? Bearish divergences.
Yep.
Prices are making higher lows, higher highs in price, lower high in momentum. And, sure enough, it's an indicator that things are reversing. So, David, very simple. I'm not trying to complicate things.
I like that.
That's me in a nutshell.
Yeah, that's great. And but it can be complicated to some people because they see a divergence. They see the RSI trending in one direction and yet the price action and the 200-day moving average trending in another direction. They may not know what to do in a situation like that. And that's where you provide assistance. That's where you help people on your website, which I think is great. Now, I wanted to talk about, let's say, support and resistance, perhaps, because I know you use that. I've tried using support and resistance myself. I like the concept and I think it's a great idea, but sometimes it just doesn't work for me. I think something is building a support level and then it just breaks right through it. Or same with resistance. I'm thinking, how can I use support and resistance more reliably, more effectively?
So again, just for the audience out there to define support within a declining market is where the buyers are stepping in, where there's an overwhelming amount of demand relative to supply, right? So if the blue is price and this red line here is support, every time prices get down to this level, it bounces, right? There's more demand than supply. There are more buyers and sellers at this level. It's not an opinion, right? This is just fact, right?
Sure.
It's very clear that that's what's taking place, right? It's just math. So, when we recognize that support is there, and then resistance is the opposite, right? So let's just quickly define that. And this is all, you go to allstarcharts.com, just click education at the top. It's all there for free. Just check that out. So it's good. I like having it there because I've written about it in the past, and it's just a good resource. Like in this case right now, I didn't know that I was going to go through the site, but I could just boom, boom, boom. I know where I can find you, pretty pictures, right?
Right.
So this is support, and then here's resistance. It's very simple. Resistance is when you have an overwhelming amount of supply relative to demand, more sellers than buyers. Every time prices get to that level, it rolls over, right?
Yeah.
It's just very simple. So that's support and resistance. So your question is how you can, let's see.
Yeah, how to use it more effectively, because whenever
Sure.
I think I've found support and then it just breaks right through it. And I'm like, okay,
Well,
I was wrong.
I'll tell you right now. So the way we want to think about support is not so much, we don't want to draw our trend lines with pencils. We want to draw them with crayons. Okay. We want to think of support kind of like a mattress. When you're a little kid and you get to a hotel room, you get on the mattress, you start jumping up and down, right?
Yeah.
It's got give to it. It's not an exact flat line, right? You can bounce on that mattress. It's more of an area. So think of it more like we want to be more like ranges, for example, right? So in this case, I want to show you a great example, and we're looking at, this is gold miners. These are gold miners in throughout the second half. Sorry about that. Throughout the second half of 2015, right? So 6 months of sideways action within a downtrend, right? Beautiful downtrend in gold miners, right? Hot mess. Take this out here, right? So beautiful support. A lot of times what happens, and I love to take advantage of it, this is my favorite trade, is when support is broken, right? Notice how it's not an exact line. Like we have a little bit of a lower low here, a little bit lower low. This one's right around that level. So it's more of an area, right? So that's the first thing I want to say. And then second of all, there's going to be whipsaws, right? Particularly before the end of range-bound markets, when you see these whipsaws, expect the resolution to be in the exact opposite direction. So in this case, you got a breakdown to new lows, right, in gold miners. You get the 26-year-old journalist who just got brought over to, the media outlet du jour from Court TV or something like that. Bless her heart, she's probably super smart, but never traded a stock in her life. So she wakes up in the morning and she sees gold miners, and headline is gold miners hit new 5-year lows on. And then whatever news item of that day, you just fill in the blank, right? That's just the way it is. That's what they're taught to do.
Right.
I mean, they're useless, right? So that's when you get gold miners, and then go back to that date. You'll see it. It'll be hilarious. Gold miners make new lows on the backs of whatever. Somebody in Europe said something about the dollar. Who knows, right? Some explosion somewhere. Who knows? So you make a new low, and then what happens is a lot of times it'll hang out down there for a few days or a few hours, depending on your time horizon, and then quickly get back above that support. And then what happens is that anybody who got short, right, waiting for that breakdown is now wrong. And then anybody who put their stop losses below that support and said, hey, okay, I'm going to stay long only if we remain above support from the last 6 months, they get stopped out.
Yeah.
So now you have the longs that got stopped, You got the new shorts that got excited to get short in the so now you got both of those groups wrong. The shorts are wrong. They need to cover. Those are natural buyers that this is what I call oh shit mode when the shorts are like, oh shit, I got to cover, right? And then you also have the longs that got stopped out. They're like, oh shit, the market's ripping and I'm not in it anymore, right? So that's when you get from failed moves come fast moves in the opposite direction. So what's happening here, this is all oh shit mode right here. They're all like, oh shit, we got to cover. Oh shit, and then that brings in the momentum guys like me, and then the rest is history. So I wouldn't be so much afraid, David, of breakdown supports. I would look for them, anticipate them. And in this case, it was clear you got new lows in price, and look at momentum. Yeah. Nowhere near oversold conditions. Huge bullish divergence. You knew right away something had changed, and then sure enough, that was confirmed by the overbought conditions. And then notice how during this rip your face off rally here, momentum never got anywhere near oversold conditions. In fact, during any corrections, it's staying way above 50, showing you just how strong this trend was. So that's how you can kind of incorporate momentum with support and resistance.
That's great, because so many people would look at that last move there as it was going down. They would say, oh, it broke support. Bearish. I'm bearish on it now. But you're looking at multiple indicators, and you're looking at the big picture, and you're using your extensive experience with this to see what's really going on.
And not to mention that I have a workbook of 150 charts that are just gold miners, gold ratios, and they all look like this, by the way. So it's not like one chart. That's why there's no holy grail, right? People tell me, JC, what did you see here? And you know what? I looked at every single chart, and it's impossible. You have to be blind to have missed it, because if you just keep getting punched in the face over and over, you're eventually going to move your head out of the way, right? Yeah. It's the same thing. If you have 150 gold charts that all look exactly the same with all these failed breakdowns and bullish momentum divergences, it's like, hello, right? So here, let me show you another example. The U.S. dollar, same thing. Here's a great example. This is the U.S. dollar index at 100.
Dollar's been getting wrecked this year.
Absolutely wrecked. And what's beautiful about it,
and part of me wants to, the contrarian part of me wants to get in, but then the part of me that says, well, the Fed's just going to keep printing money, so I don't want to get in the dollar right now. I don't know what to do. What do you think?
I think that we are towards the bottom of a range, and I'll show you exactly why I think that right now. I want to show you what happened here exactly. Yeah. This is one of my my all-time favorites. I mean, this is just fantastic. Why can't? Oh, here it is. So here we have clean resistance at 100 in the U.S. dollar index. This is in early 2015. Once again, in late 2015, ran into 100 and failed, right? So it's not my opinion, it's just fact that there's clearly an overwhelming amount of supply relative to demand for US dollars at that 100 level, right? Fact. Now here we are breaking out. So this is in early 2017. This is suggesting that all of this overhead supply has been absorbed by that demand, and now we are ready to continue higher. But similar to the gold miners, where from failed moves come fast moves in the opposite direction, because sentiment gets really just to the extreme, people are just throwing in the towels. Think of this like a rubber band effect, right? The rubber band had been so stretched here that when it was let go, it was boom, a huge explosion, right? Yeah, right. Same thing with the US dollar. Anybody who said, hey, I'm going to stay short unless we take out these highs gets stopped out, so now they're no longer short. And anybody who's trying to buy a breakout buys the breakout. So once we break back below this level, what happens is anybody who bought this breakout is now wrong, and anybody who was short that got stopped out is now no longer short. So they need to unwind. So this is what we call oh shit mode. But when you can incorporate some sentiment, this is the Economist cover story with King Dollar, okay, with George Washington looking like Arnold Schwarzenegger here on, look at the date. What is this? Look at the date. Look how they're trying to get me to buy this. I don't want to buy it. I just want to look at your cover. Look, December the 3rd, 2016. I kid you not. This is King Dollar. Okay, wow. Why a strengthening dollar is bad for the world economy. The Economist. You gotta love them. Like an ugly little kid. Like they're just adorable, right? So this is December the 3rd. This is right around here, where it's just like, hello, this is my grandmother's calling me. hey, the dollar, we should buy the dollar. No, so it's great when you can. And by the way, on the new highs in price, momentum was putting in lower highs.
Yeah.
Beautiful bearish divergence. So when you incorporate sentiment, support and resistance and momentum, I think it's really using all of them together. And then in the case of the U.S. dollar, you have a polar opposite in the euro, right?
Right.
So the euro was here's that support, right? I mean, same exact thing, but the opposite. Bullish momentum divergence, right? And when was that article written? December. The article was written right around here.
Yep.
So, I mean, you can't draw it up any nicer than that. Nice little bullish divergence, right?
Yep.
So, I mean, it's really about incorporating all of it together.
Sure. Do you look at a chart like this and say, "Oh, inverse head and shoulders" or whatever? Because you could almost imagine there's so many quote unquote chart patterns. I mean, do you look at things like that?
I do. When you look at it, as many charts as I do, you recognize them all the time. Head and shoulders patterns are very rare. People often quote them because they're named after a shampoo or whatever.
Right.
So they're easy to remember. Things like golden crosses or golden showers or golden whatever the death cross, right? All that stuff. Like they're all that stuff it's not so much what they are, it's more the implications, right? And yeah. I'm not into the crossovers, moving average stuff. That's not for me. But with respect to patterns, it's not so much what they're called, it's what they represent. So yeah. A head and shoulders pattern is a reversal pattern, but markets by definition trend. So to be looking for reversal patterns, you're essentially defeating the entire purpose of what we're doing here in the first place, which is trying to identify the direction of the primary trend and participate in that direction. You're looking for shampoo patterns, like you're doing the opposite of that.
Right.
So what we're really looking for is we're looking for stuff like this. We're looking for symmetrical triangles within ongoing trends that signal continuations, right? That not reversals. This is the kind of stuff we're looking for.
Yeah.
Right. And you can find them. Just look at any trend. I mean, look at the FTSE. You find like consolidation patterns all the time. Look at DAX. Nice little rectangle here within an uptrend. Beautiful base breakout. These are continuation patterns. That's what we're looking for, not head and shoulders tops. But they do exist. You can look at the Dow Jones Industrial Average. I mean, this is one of the more infamous ones, right? You have your left shoulder, your head, your right shoulder, yeah. Your retest of the neckline, and then crashola. Yep. But here you got your nice wedges, your rising wedges with continuation pattern. Look at momentum, never hitting overbought conditions, never even getting close throughout 2008. So there was really no reason to think that these weren't counter trend rallies.
Yeah. I'm going to start looking at 14-period RSI differently now. That's really interesting. It's so contrary to the way so many people read it and think of it. So I think that's really fascinating.
Yeah, think about it, David. People are like, "Oh, it's oversold. I can't. We got to buy it. It's oversold." Or, "Oh, I can't buy it because it's overbought." Think about the logic behind that. How can an overwhelming amount of buying possibly be a bad thing?
Good question. Yeah. You're right. The question. Yeah, no, you're right. It's causing me to think differently about it, and obviously it's working because you have the training where you can see the divergences. You're looking at these things, and it's just funny, that headline that you just showed, or whenever you see that old "markets in turmoil" meme on certain networks. it's almost,
I just don't understand why those come after the fact. Where are those market in turmoil before? You know what I mean? Yeah. Like by the time the 26-year-old journalist decides it's a good idea to tell the public, like right. It's over, or a big part of it. Like we need to be taking the other side or looking to take the other side, But again, it's not just because a TV network is late to the game doesn't mean the game's over, right? Or right. Just because my grandmother is asking me about the euro, doesn't mean that we need to take the other side. Gotcha. So anecdotal evidence is what it is. It's one antidote. It's fun to joke about, in this sort of format because we can make fun of economists and whatever. We're just joking around, but what these, and you see it in Barron's and you see it in other Time Magazine. It's not their fault, right? What they're doing is they are gauging the market sentiment. They are seeing what people around them are saying and thinking, and those cover stories are based on what sentiment is taking place at the time. They're actually these media outlets are very good at giving the people what they want or what they think that they want,
Yeah.
so we can essentially take that as sentiment information to kind of gauge whether the crowd is at certain extremes, right? Because
Sure.
remember, sentiment
Yeah.
99% of the time is useless. Sentiment is only valuable when it's stretched to historic extremes.
Right.
That's when we want to pay attention.
And speaking of that, and finally, I just wanted to touch upon this topic that's so widely discussed, this toppy, frothy market. And I put those words in quotes, toppy and frothy. I've read so many of your tweets. By the way, people need to check out JP Parets and AllStarCharts on Twitter. I'm sorry, JC Parets on Twitter. He's a very prolific tweeter, whatever the right word is. Lots of great information, and you can get his latest thoughts on it. And clearly, you tend to disagree with the idea that these markets are just up too much, too fast, too far.
Yeah, I mean, I don't buy that at all. Particularly the thought that we are in the ninth year of a bull market or something like that. I don't think that's right at all. I don't understand why, when we talk about the beginning of the structural bull market in the 1980s, we refer to 1982, and we actually have the technology, so we actually look at it, right? So go back to 1982, right? So the start of the bull market, I mean, everybody says 1982. This was the start of the bull market. Yeah. That led to, right? That this was a 20-year bull market essentially. I mean, you could really see it, right? So here's a 20-year bull market. It started in 1982 and peaked in 2000, right? 18 years. What a monster! You can see the 1987 crash here, right? Mm-hmm. But if you focus in, people talk about the 1982 as the beginning of the bull market. Right. They don't talk about the exact bottom in 1974 of this huge sideways range, right? Nobody talks about 1974. Everybody talks about 1982. So why is the bottom 2009 and not the breakout in 2013 or the retest in early 2016? That was, to me, the bottom, and I would make a very strong argument that the start of the bull market was at the bottom in January of 2016. That's when I would argue, because that's when emerging markets bottomed, right? If you're looking at EEM, I mean, emerging markets had been declining since 2011. They were in a 5-year decline and didn't bottom until January of 2016. So that was a very, very important bottom. You can even argue, if you want to really look at the European banks, which were the biggest problem, right? The biggest reason why I was bearish throughout the entire second half of 2015 was because of European banks had a lot to do with it. European banks didn't bottom until that summer. So July of last year, when the S&P 500 broke out, if we look at the S&P 500, when we broke out last summer, this is July. This is July when S&P 500 broke out of this monster downtrend, right? That was in the summer. At the same time, the European banks were bottoming out. At the same time that, by the way, interest rates were bottoming out. Okay, and then the leaders, things like emerging markets and stocks and U.S. stocks were already putting in higher highs in the S&P 500, right? We were already going, say, in the summer of 2016, and we were breaking out, while some of the laggards like Europe, like European banks and U.S. 10-year were still making new lows. Although you could see a nice bullish momentum divergence at those new lows in European banks, but you can even make an argument that we are just entering the second year of a bull market. I can even make a strong argument for that, and suggest that maybe the emerging markets and Latin America and base metals bottoming out in January of 2016. They were early to the game, and they're the leaders moving forward. And sure enough, we've actually seen that. Copper and lead and tin and all of those bottomed out in January. So and they've been leaders ever since. So. We can date it to January. We could date the start of this new bull market to last July. I think either one makes good sense. You can even push it back to 2013 if you really want to get cute about it, even though emerging markets continue to get destroyed. European banks and all European stocks in Japan kept getting destroyed after that. But it certainly was not 2009.
You've got me rethinking everything I thought I knew, and everything I thought I knew might be wrong. Second year of a bull market, and that's fascinating. You even tweeted recently, and by the way, the Twitter handle is at AllStarCharts. I recommend everybody check that out. Um, you wrote, "For you serial pessimists, technology just went out at a 17-year closing high. So new high, not new low, uptrend, not downtrend." You can't argue with that. You're looking at the data, you're looking at the facts, no emotions, no sentiment. You're ignoring the noise. And yeah, perhaps this is a beginning of a new bull market. I'm really going to have to rethink everything I thought I knew.
I
There
mean,
it is.
think about this.
Yep.
Look at this. This is technology going out at 17-year highs, not 17-year lows,
Right.
17-year highs. How is that possibly a bearish characteristic? In fact, technology is the largest component of the S&P 500. So you can make a strong argument that it's actually the most important sector on planet Earth, right? Because if it's the biggest sector in the most important country, you can argue it's the most important on Earth, right? A very solid argument, or maybe financials, but at least top two, right?
Yeah.
And by the way, 17-year closing highs today also, these are 17-year closing highs are things we normally find in uptrends, not in downtrends.
Right.
And here we're looking at technology going out at new highs again. What I would point out to, forget the United States, the big thing that really gets me going from a longer-term structural perspective is London. We can argue that the London FTSE 100 is top 3 most important indexes in the world, top 5,
Sure.
right? But it's got to be in the conversation of the most important indexes on Earth. There's no doubt. And here we are coming out of a 20-year base this year. If you were buying British stocks at the end of 1999, you just got back to break even at this year. So, when we talk about the market being frothy or stocks being too high, FTSE just broke out. They literally just broke out of a 20-year base. So I can't possibly be bearish stocks as an asset class if the FTSE 100 is just breaking out of a monster base. And you can even look at Germany also. This is we're bumping up against former highs. What happens if Germany breaks out here? Whoops, sorry. Right? What happens if Germany breaks out here? Retested it. What happens if we break out here in Germany? How can you possibly be bearish stocks if Germany's ripping to new all-time highs? Tell me that. I'm not. If we roll over, notice how momentum never hit oversold conditions on this correction in German DAX, right? Notice how German DAX hasn't gotten oversold in a year and a half. Okay, these are bullish characteristics, not bearish ones. The German DAX is making higher lows, higher highs above an upward sloping 200-day moving average and momentum in a very clear bullish range. There is nothing bearish here. Now, if we were to take out last week's lows, we break that 200-day moving average and momentum gets oversold, we're having a completely different conversation.
Right.
Okay? But that hasn't happened. In fact, the likelihood of that happening is slim to none. Okay? So if that happens, we'll worry about that when the time comes. For right now, based on the weight of the evidence, there is very little chance that that's going to happen, and there is a very high likelihood that we're going to resolve higher in the direction of the underlying trend, which is perfectly normal, go on to make new all-time highs. And brother, if German DAX is making all-time highs coming out of a 2-year base, I can't be bearish stocks.
It's amazing. I've seen these charts so many times, but I'm looking at them differently. I may never see them the same way again. This has been so educational for me. I know that people will gain so much from allstarcharts.com. I'm looking on there right now, actually. I see you've got a blog on there. I see you've got plenty of education, both free and premium. Testimonials, advisors corner, all kinds of cool stuff. People need to
Yes, if you go to testimonials, you can see, what people have, been saying. I'm lucky. We haven't even updated this in a while. We have a ton more that we could put up. People have really the nicest things to say. I really am just so lucky.
There's Howard Lindzen. All right, yeah.
There's Howard Lindzen. Yeah, yep. Howard's been a fan of All-Star for a long time. I'm lucky to have met Howard at a young age. He actually helped build my blog originally. There was something called the StockTwits blog network.
Ah,
with myself and a handful of others, including Reform Broker, including Greg Harmon,
mm,
Phil Perlman. There was those a few original StockTwits blogs, which was really cool to be a part of. And then eventually, they cut that off and we all went our own ways, which is fine, but we're still friends.
yeah.
So yeah, so Howard, so go to allstarcharts.com. You can go to Advisors Corner. In here, I actually can log in. You'll be able to. What I like to do is, I'm not actually logged in. But either way, you can see what all of the. You know what? Let me just log in. Why don't we just do that? We have the technology, right?
Yeah.
I
There
like to
you go.
say.
Yeah, I mean,
Um,
while you're doing that, people should at least try out the risk-free 30-day trial, see what it's all about. Learn all you can, and then you can decide whether you want to stay with it. I imagine you'd want to. You know.
what's cool is that since we do offer if you go to allstarcharts.com/join, right, we actually do offer a 30-day risk-free trial. So what's cool is that I go to sleep at night every single night knowing that, listen, if you don't want to be here, if you don't want to be part of this community, like that's cool. Like we're not forcing anybody to do anything that they don't want to do, and
Sure.
that's what's cool. A lot of scummy research guys or whatever, newsletter writers, for years, not just that's not nothing new, for decades. They try to hook you into getting into something. We don't hook anybody into anything. If you don't like it, you can cancel at any time.
Right.
You're not stuck to anything. So I highly encourage you to allstarcharts.com/join. Check that out. And then we have an advisor's corner. So really all this is a way for us to help financial advisors really serve their customers. We have a huge base of financial advisors that use All-Star Charts, and they wear multiple hats. Not only do they have to service their customers, they have to go and build their books and
Yeah.
have meetings and stuff like that. So advisors can come, and rather than having to read through all my research to get, this cuts right to the chase.
Mm.
What are the most important things here? We're looking at emerging markets and copper. What are the most important things in each one of those research reports? And then I think, one of the biggest advantages is the chart book. This is just through the help of technology. There are 500 charts here that I update on a weekly basis. Here are all of the U.S. sectors and subsectors. These are all of the U.S. averages, including S&P 500, Russell 2000, and some equally weighted stuff that I like to incorporate. All the bonds and interest rates charts, all of the international indexes, which I find so valuable to take a weight of the evidence approach to equities by looking globally. All of these indexes are listed here. We actually just added a bunch, so this isn't the entire list. You can go to international indexes and you can click on each one of these workbooks and you'll be able to get the entire list. So you can see all of the charts and notice how they're all on weekly and daily time frames.
Yeah.
So we like to incorporate a multiple time frame approach. So here's the FTSE London FTSE 100 breaking out of a 20-year base, and then you can look more short term at some individual price targets and things of that nature. So we do that for every single one of the indexes, and then I like to get down to the individual stock level as well. So one of my favorite exercises is going through all 30 components of the Dow Jones Industrial Average on both a weekly and daily time frame. And listen, it's only 30 stocks, and if there are more good ones than bad ones, it's going to be hard for the market to go down.
Mm.
And if there are more bad ones than good ones, it's going to be hard for the market to go up. That's really just the bottom line. So each one of these charts is on a weekly and daily basis, and I do the same thing for the Dow Jones Transportation Average as well. And then I don't publish this, but I do go through the entire S&P 500 on a monthly basis, or at least a couple of times a month, really. You can actually go here, a not so random walk through the S&P 500, and I go through all 500 stocks, so 1,000 charts in total, and I go sector by sector, all 10 sectors, and pick out, what I think stands out, what I think tells the story, the buys, the sells. And then at the end, I'm like, well, are there more good ones than bad ones? Or are there more bad ones than good ones?
Right.
And in this case, let me tell you, I looked at over 1,000 charts, and there were just a lot more good ones than bad ones. I mean, that's just the bottom line. So, go to allstarcharts.com, check it out, go to education. All that material is there for free. If you're curious as to, what it is that I'm talking about, feel free to go in there and check it out.
That's fantastic. That's crazy. JC Parets is looking at hundreds and hundreds of charts, so you don't have to. Just the time saving that's going on here. It makes the subscription well worth it. And with a risk-free trial, what do you have to lose, really? So I think that's fantastic. Actionable trade ideas, weekly newsletter, all those charts, conference calls if you want that to be part of your membership. That's available as well. Different
Yeah, we do
levels.
a monthly conference call. That's a member favorite. There's no
Yeah,
question. Our
sure.
call is actually on Monday. I just scheduled it. So
Yeah.
all the members from all over the world, they log in. They can ask questions. We talk about the most important things that I see out there. Risk management. Hey, if this happens, then we're gonna have to reevaluate the thesis, etc. And then we obviously keep them archived. So you can go to the top and you go to click here to listen to the latest monthly conference call, and then you can go here's July, June, May, April, and you could just click on any of them you want, and you could just press play,
And there it
and you
is.
could see the entire thing.
Yep.
And then as I just go through all the charts, see?
Right. There it is. That
There
is
it
so
is.
cool.
So
Wow.
that's
Nice.
it. So that's All Star Charts in a nutshell.
Whew. Well, that's quite a bit. I'm going to have to go back and watch this video several times, and that's
That's
okay,
cool.
because there's so much information. And this has been a power-packed, half hour we've done here. Mr. J.C. Parets, thank you so much. People need to check out your tweets. It is at AllStarCharts, and of course, people need to check out AllStarCharts.com. And allstarcharts.com/join if you're ready to join into it. Is there any other way for people to reach you?
Find me on Twitter at All Star Charts. Make sure that you go to allstarcharts.com, and don't forget to check out the new podcast on technicalanalysisradio.com, where I'm interviewing the best technicians in the world. There's no question. We started with Ralph Acampora, the godfather of technical analysis, episode 1. And then we just had Ari Wald, who's the head of technical analysis at Oppenheimer.
Nice.
These are killer conversations with really smart dudes and dudettes, for that matter, coming up soon. So, make sure, you check that out as well. It's all free. We're on iTunes. Just a lot of cool content. The way I look at it, David, kind of like I'm rapping with you. I'm talking with these guys anyway, so I might as well press record.
Right, right. Well, you say you're interviewing the best of the best in the world. Well, you know what, so am I. And today I've had one of the best, if not the best, when it comes to charts. AllStarCharts.com, at AllStarCharts on Twitter, Mr. J.C. Parets. Thank you, sir, for joining me today. You're welcome back anytime on Looking at the Markets.
Absolutely. Thanks for having me, David.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.